If you've made serious money in crypto and you're now wondering, how do I cash it out in my home, high tax country without having to move to some tax haven? This video will show you how. I'm going to walk you through a legit, reputable structure that lets you legally pay zero taxes while staying right where you are. And in the next few minutes, we'll break it down using simple analogies, no legal jargon, so that you actually understand how and why this structure works, why you get to pay no tax, and then you can use those underlying principles for future offshore setups. Without further ado, let's dive in. The simplest way to cash out large crypto gains tax-free is obviously to just pack your bags and move to some crypto tax haven, like Dubai. But let's be real, guys. Not everybody wants to live in a scorching hot desert. And if you haven't heard about it, Dubai rent is not free. Most people, they don't want to leave behind their businesses, families, communities, just to pay a little less in tax. This video is for those of you who want to stay put, who want to stay home, but not fork over half of your gains. And the core legal principle that allows you to do that is the following. Most countries do not tax foreign, undistributed, active income. Let me break it down in simple English. If you own your cryptos through a foreign company and you're not cashing it out to yourself personally in your own name, you just leave it in the same foreign company, then it's usually not taxed back home. Why? Because your taxman sees it as part of an active business abroad, not income that you've received in your own name. The tax authorities will see it as growing the business, you're reinvesting it, maybe paying off company expenses, saving it for later. And this strategy works for the EU, the UK, Canada, Australia, except the US. Ever since Donald Trump's 2017 tax reforms that screwed over every American. So if you're a US citizen, this exact strategy won't work for you because you're taxed on your worldwide income, but the analogies and the explanations may still benefit you for other offshore setups. Now, let's assume that you're living in the UK, pushing the buy and sell button from your laptop in London. Instead of owning all of your crypto in your personal name or through a UK company, you can set up a foreign company, like an Estonian LLC, to do all of the trading. Why Estonia? We'll get into that in just a second, but first, here's what you need to know. Obviously, the company is registered in Estonia, and for this example, you'll own all of the shares, making you the ultimate beneficial owner, or UBO in short. Most importantly, you are managing and controlling the company from the UK, since that's where you live, also known as the place of effective management, or POEM in short. And that's where the real games begin. Because most people, they get screwed over by this POEM rule. It's what makes it impossible for you to set up a cheap offshore company and magically pay zero tax in a tax haven, because even though the company is based abroad, your home country, the UK, Canada, Australia, France, Germany, they still want a slice of the profits. And they'll do that by asking a simple question. Where are the strategic decisions being made? i.e., where is the owner located? Where is he pushing those buttons, making the trades, deciding on what the company will do? And this is such an important concept that let me use a simple analogy with a remote control car. Sure, that remote control car may be driving in Estonia, maybe even legally based there, but you, with the actual remote controller, are sitting in your home high-taxed country. So even though the car is in Estonia, who's actually controlling it? You are. And that's all that the tax authorities actually care about. That's the place of effective management. Now, you may say, sure, whatever, I'll just hire a local director in Estonia and he'll act as the manager of my company. Problem solved. That's where Controlled Foreign Corporation Rules, or CFC, as well as the concept of the ultimate beneficial ownership kicks in.
Because your home country, they don't just look at where the company is based or who's the director on paper. They want to know who's actually running and benefiting from the company. Because if you, the real owner, have significant control, like owning a lot of shares, it will be viewed as being taxed at a local level, back home. So this means that if you own a certain percentage of shares, or if you have too much voting power, or if you control the bank accounts, your home country, the UK, France, Germany, whatever, they're going to tax it with the local tax laws.
Let me give you a simple analogy. A few years ago, during the pandemic, most governments did not directly censor their people. Instead, they used independent social media and tech companies to do that for them. And even though these companies pretended to be independent, if you actually dig deeper into the shareholder structure, you would find government connections and control all over the place. That's significant influence, even if it's not directly on paper. And CFC rules, they pretty much work in the same way. Each country has their specific percentages. Usually it's if you own about 20% of the company or have control in it, that triggers CFC. And if you cross that threshold, your company's foreign income can be treated as if it were earned right back home. Now, just so that we're all on the same page, the reason why CFC rules do not affect you in this example, as long as you're not an American, it doesn't affect you if you're a Canadian, Australian, European, or a Brit, is because you're not cashing out the cryptos in your personal name. You're keeping them in a company. And legally speaking, businesses are only taxed when they pay out, as long as the country does not have a tax on undistributed dividends. And that's why we chose Estonia, because it has zero taxes on undistributed dividends, and also because you're not selling goods or services, you're not going to have to pay the value added tax. Unfortunately, Estonia did add a defense tax due to the Ukraine war for 2 years. So starting with next year, you would have to pay 2%. But I'll get into it later down the video on how you can get around it with creative accounting. Most importantly, Estonia is seen as a reputable country, which means banks will actually open accounts for you, payment platforms like it, and your home tax authority won't immediately assume that you're hiding something. Because first world countries, they have anti-avoidance rules for all these tax havens, and they scrutinize the hell out of these cheap banana republics. The first thing that comes to their mind when they see a Seychelles company isn't, oh, this is legit, it's time for an audit. But wait a minute, what's the point of all this setup if I can't use my money? You're telling me that I can't cash out into my personal bank account. Simple. Firstly, it allows you to pay way less tax on your crypto without having to move abroad. And secondly, when it comes to actually cashing out that crypto tax-free, you're going to leverage two tools that only a company gives you. You're going to borrow against it, and you're going to buy things as business expenses. Both will require flexible accounting because it's the only way you can turn your corporate profits into an actual lifestyle upgrade tax-free while maintaining a compliant structure. And this part is extremely important because most countries have disguised distribution rules, which means that if you're taking a loan out of a company that's yours, the government, they won't assume that it's a loan. They'll assume that it's a hidden payout, and they'll tax you on it. To avoid all of that, you want to build distance between yourself and the company. And that's where these nominee shareholders, trustees, and silent partnerships come into the play, because they help remove you from the paperwork so that the loan acts and behaves like it came from a third party. And the same thing applies to business expenses. Sure, you can buy all the property, you can buy your company car, cover your travel expenses. It's all legal as long as the purpose is crystal clear from a business perspective. If you're buying a $300,000 Rolls Royce in Estonia for your crypto trading company, the tax man is going to say, well, what's the purpose? Is it for marketing, branding, client acquisition? And if you don't have a reason, they're going to say, dude, what are you doing? So the goal is to use this structure as a long-term tax-free compounding vehicle for your crypto gains and build this framework so that you could justify, say, owning real estate as a commercial asset, or paying yourself a modest taxable salary back home while the real gains stay in the company, and of course using crypto-funded private placement life insurance or B2B contracts with trust-owned entities to acquire assets without triggering tax. Both Panamanian and Liechtenstein trusts can own Estonian companies, so that would be a good place to start. I've made several videos on all these aspects and you can check them out over there. Now to summarize. First, you're going to set up a foreign company in a reputable jurisdiction, such as Estonia, not some cheap banana republic, preferably one that doesn't tax undistributed profits. And then you're not going to distribute those profits personally, you're going to keep them in the company to grow the business. And you'll use a flexible accountant to borrow against it and justify expenses to actually use the money. And you want to build an actual business infrastructure to give a clean paper trail for all of your crypto for whenever you want to cash it out. And that's how you continue trading your cryptos legally and reduce taxes without having to move to some scorching hot desert or a third world country. Anyway, that's it for today's video, guys. If you enjoy this type of content, as always, you can comment down below or share it with a friend. It does help with the algorithm. I made a previous video on the countries with the worst AML laws. You might want to avoid them whenever you want to actually cash out your cryptos into banks. Be sure to check it out over there. But I'll be seeing you next time. And until then, bye-bye.